All right, so it looks like we're live. We're going to have a conversation today with Cedric. So Cedric's a friend of mine in Hong Kong that I worked for quite a while. Worked with for quite a while at MSCI. We're actually both here in Hong Kong and had a chance to meet up on the tail of my visit over to China. So I already had a chance to meet up with Cedric, and we already had some conversations about Chinese investing and things like that. So there's a number of things we want to talk about today. Wyatt's joining us here. I suppose everybody's able to ask questions, Wyatt, I presume, as we're going through these topics. So perhaps the best thing to do would be what did we do last time? Why did we field them as they were coming up?
Yeah, I think we kind of checked in as we had some pauses to see if anyone had said anything. I've got it pulled up here so I can, maybe just chime in if we get a pause.
Yeah, absolutely. Okay.
Yeah.
So we did a couple videos recently. So I was traveling in China. I was meeting with our head of China, Stefan, and we've been trying to, Cedric, maybe I mentioned, trying to deploy our content on Chinese social media channels, and we started with subtitles. Then we worked to an AI algo that translated what I was saying into Mandarin at real time. It actually worked okay, but there wasn't a very good uptake, and that could be the interest from Chinese investors in investing in United States firms. So at any rate, the number of things came out of that visit. First of all, I was overwhelmed, as I always am, at how fast China's progressing, and just what a spectacular place it's become from when I first visited it several decades ago. And one of the things that came up we'll talk about is China exposure, but I wanted to really start out by digging into what has been the biggest point of contention from our side when it comes to investing in China, and that's VI structures. So I'm going to explain that. I believe that acronym stands for Variable Interest Entity, and here's how that works in a nutshell. So there are a lot of restrictions on what foreign investors can invest in when it comes to Chinese firms. In particular, sensitive things like technology stocks and things like that. So there were restrictions in place that would keep you from investing in, let's say, Alibaba. No, so what they did is they came up with a VI structure that's this, it sort of has elements of a SPAC. It's that convoluted or a very convoluted structure where you don't actually have legal right to hold the shares that you think you do. That's what it boils down to, right? So it's a way to sidestep the restrictions that the Chinese government had put in place. Now, we noted that for nearly all, if not all, stocks of that nature. What are the stocks that Americans are interested in? They're interested in Chinese tech firms. Those were all listed in the United States as VI structures. All right. So we said, look, that's a showstopper. We wouldn't invest in any of these firms because the Chinese government can pull the rug on those anytime. So we said, well, if we invested instead on the Hong Kong exchange, then that's going to be safe, right? So we're not going to use the VI structures in the United States. We're going to invest in these issues on the Hong Kong exchange. We actually did a recent video that hasn't been published where we sort of concluded that that was the way forward. But then Wyatt did some more digging and found out that really what's happening, it appears to be what's happening, is the VI structure is on the Hong Kong listing, all right? And when those shares then trade in the US, that's simply just a typical ADR. So it's listing the Hong Kong shares in the United States as any sort of ADR would work. So you still have this VI structure on the Hong Kong exchange for loads of assets, any asset that we might be interested in investing in. So a couple of things came out of that. And Cedric, I want to sort of hear your thoughts. First of all, and this came up before, ETFs. I looked at some of the large, so MSCI's iShares China, or the Franklin ETF we were looking at. I think it's 19 basis points. That seems to be a really good low expense ratio for Chinese exposure. That was this recent video that we did looking at exposure to China. these ETFs are all holding those VI structure assets on the Hong Kong exchange. All right, so they're taking on that risk, and the belief seems to be, well, if China ever did something there, that they did a rug pull, it would screw over all these large asset managers. They'd never do that because it would damage their reputation and this particular industry segment so much that would never be an option for the Chinese government. So it's sort of a risk that you have to accept, and it is an extreme black swan. So I really want to think that through a little bit, Cedric, and see what your thoughts are about that. Basically, this is illegally listed assets on the Hong Kong exchange that everybody has just accepted.
Yeah, I think we have to look at all the different stocks that are listed in Hong Kong. So as you know, stuff that are listed in Hong Kong include, Chinese companies include H shares.
Mm-hmm.
It includes red chips.
Mm-hmm.
It includes actually some companies that are listed in the US and come back to Hong Kong and list. I looked at the VIE structure for companies listed in the US, and there was a recent, I think it's from the SEC. It lists around 159 companies listed in the US that are listed via VIE structure, and it totals around $1 trillion US dollars in total market cap. And then you've got a lot of the companies are very familiar to retail and institutional investors, such as Tencent. Actually, is it Tencent? No, it's Alibaba,
Tencent,
Trip.com, Pinduoduo, Yum Brands, Xpeng, which is a car manufacturer. Actually, that the list is actually quite long. It's 159 companies, and 91% of those companies are listed via VIE structures. Look, there is definitely some concerns around how VIE structure came into life probably over 20 years ago, when foreign investors trying to invest into Chinese companies in potentially restricted industries such as telecom or internet and so on. And the VIE structure. So look, I'm not a lawyer, but originally it was designed to be sort of like primary investments into those industries, and then subsequently these companies then have listed, have gone IPO over the last 20 years. Yes, if you look at the details of how the contracts that are laid out between the foreign entities and the local entities within China that holds the rights to some of the contracts to operate in China and so on. Yes, there are definitely some concerns. However, I would say you have to look at the types of companies that are listed in Hong Kong. They're quite different to those listed in the US. So, for example, in Hong Kong, you've got companies that are listed at H shares, which operates differently.
Understand, yeah.
Right. So, for example, these are like the
BYD is an example. BYD,
China, and so on. But the things that are listed in the US, where a lot of the retail investors are accessing, and so certainly institutional investors will also invest in, because some of the companies only list there. But there is a difference between you being a retail investor, whether you can access the Hong Kong market directly, or you're trying to access the Chinese exposures via US exchanges, right?
Right.
So, for example, you can't buy Bank of China in the US. They're not listed over there. They're listed in Hong Kong, right? So there's a Hong Kong ticker. Whereas you could buy Alibaba both in Hong Kong and in the US. So you can buy Baidu in Hong Kong and in the US. Clearly, as you said before, there is potential risk in investing in VIE structures, because in the worst case scenario, the nuclear option, where the contractual agreements between the foreign entities and the local entity is not recognized, then essentially you have no rights to the economic benefits of, right? So essentially your investment drops to zero. However, I think as in investing in any any companies around the world, even in emerging markets, you have to look at the risk, look at the the possibility of such things happening versus the potential outcome of investing in these type of companies.
Seems like this is a little bit more of an extreme case where the government has said you're not allowed to invest in these things, and then a workaround became so popular that really gives the government more leverage in this case than I would think in any other situation regarding risk in emerging markets. This is very systemic, so I think it remains to be a black swan. But so there's a couple things there. First of all, you talked about H shares, and BYD is an H share, right? So I want to keep those separate from the conversation for right now, and just focus on the VI structures. So the first question that I would have is there any benefit for a U.S. investor to invest on the Hong Kong exchange versus the listing in the U.S.? Would there be any reduction in risk as a result of doing that?
The initial thought would be no in terms of the legal structure, but however, I think when you look at the two exchanges, so for example, you have to look at the volume that's traded in both markets. So primarily, the Chinese companies are a Chinese company, and the bulk of the volume are in Hong Kong. So for example, you look at Alibaba, there's a large amount of volume traded in Hong Kong. However, there are some clients they trade both in the US, because you can look at sort of overnight what's happening around the world, and then you can continue to get the exposure. However, I think a lot of institutional investors do invest directly in the Hong Kong exchange itself, right? So because that's where the primary liquidity is, right? So for example, Alibaba last year. So Alibaba, for example, they listed in the US, and they have a secondary listing in Hong Kong. Last year in I think August timeframe, they changed the listing in Hong Kong to primary. Okay, so they specifically did that.
What is that? What are the implications there? Is it just implications for volume and liquidity?
Well, if you want to be a primary listing in Hong Kong, there are certain extra rules, right? If Alibaba was listed in the US, they came back to Hong Kong as a secondary listing, the rules are slightly relaxed. But if you change that to a primary listing, the rules are more, and therefore actually it's supposed to provide more investor protection.
Sure. Okay, so the questions that were raised around, let's say, an ADR in the United States. This was a question raised about BYD as an ADR, but I don't think the answer is any different. If you have an ADR in the United States and the US or the Chinese government clamps down on let's say foreign investment from Americans, the first thing they might do is demand these ADRs be removed. So these, and I suppose I don't know the legalities of that, but let's assume that happens. So people were asking questions saying, well, what happens? Do I just lose my money? No, because what typically happens when an ADR gets removed is you get a notification from your exchange, and either they'll liquidate those shares or they'll give you an advance notice. It doesn't happen that unless there's some big systemic failure, it doesn't happen that a sponsor of those ADRs just evaporates their money, that vaporizes your money. That just doesn't happen, right? So I don't think that, I'm not sure of what the rules would be there, but that's one option. So now you're not able to invest anymore in that firm. So let's say that you then go to invest in Hong Kong, all right? So if I was to do that, I could do that one of two ways. If I did that with my American domiciled interactive brokers account, all they have to do is, for all brokerage firms that support trading on the Hong Kong exchange, they can simply say, if you're a domiciled American, you're not allowed to access that exchange. That's a simple way of eliminating foreign investors from those assets, right? So they could do that for Americans. And this is about the geopolitical risks that you're seeing, the current tensions between China and America. So that would sort of be the path, I think, that it would take to clamp down until you couldn't invest. Now, you would still, of course, have ETFs that you could invest in, right? You could always invest in ETFs, but investing in specific stocks, I think that's how far you could take it in terms of keeping people from investing in those assets. The other thing I noted that maybe you can confirm is there's this round lot feature of trading in Hong Kong. So, for example, if you're going to trade shares of BYD, there's a minimum 500 lot, so that's like 23,000 US. So that's the minimum amount to get a position started. So I think for most retail investors, this round lot function on the Hong Kong exchange, and I think BYD is more an exception than the rule. I think for BABA, it's much, much lower. And I think for the rest of those.
Yes, sorry to jump in. Yes, exactly. So actually, it's slightly different in Hong Kong versus say in the US. For example, in the US, you can buy one share, or you can actually buy fractional shares nowadays, right? But in Hong Kong, they have the lot thing. So essentially, for example, HSBC in Hong Kong, I think it's 400 shares. I think Xiaomi is I think it's 1,000 shares. So you basically have to look at how much the company is per share, and you multiply out. So for example, if I remember correctly, HSBC right now is what, $80, right? So you have to buy 400 shares. So the minimum investment is 32,000 Hong Kong dollars. So what? That's like what, few thousand, 5,000,
5,000 US or so, right?
Yeah, something like that. Yeah. So that's the lot system in Hong Kong, and then when you buy and sell, that's the minimum amount you have to invest in. So multiples of 400 shares of HSBC. And actually, when you invest, you can see it. It's listed, so you know how many shares you have to buy to put
right.
Yeah.
The other thing there is you would need to buy Hong Kong currency, which it's interesting because Hong Kong currency is pegged to US dollar, right, so far. So you don't really have any sort of currency diversification when you do that. So it seems like, and that's rather surprising to me, because when we concluded this last presentation, we had assumed that it was safer, less risk for a US investor to purchase shares on the Hong Kong exchange. But now that we've sort of walked through this and thought through this, I don't think there's any reduction in risk aside from that path I described where they slowly start shutting down access. But that's not a risk anyway. Come on, that's, you're not going to have, I think, an ADR provider just screw you over on your share. That's not how that system works. So I don't think that you're reducing any risk. Now, as you said, VI structure risk remains the same. So you're not really reducing any risk. You're not gaining any value either by holding shares on the Hong Kong exchange for any Chinese firm for retail investors.
Well, I think it depends on your risk profile. Actually, personally, I think, look, if you look at it globally, right? If you invest in a local stock exchange, typically you will have currency risk because, like, for example, you invest in an Indonesian company, it's listed in the local exchange in the local currency, right? So so when you invest in that company, you are excuse me, you're exhibiting the risk of investing in the company itself as well as the currency risk. Right? However, actually, if you invest in Hong Kong, the Hong Kong dollar is pegged to the US dollar. There's a range, right? It goes from 7.75 to there's a range.
Very tight, yeah.
And so you essentially kind of investing in US dollars. However, again, I think you have to look at the whole thing in total. So in Hong Kong, you're investing in Hong Kong dollars, right? It's pegged to the US. These are Chinese companies. Of course, you can also invest in Chinese company onshore. Now, there's a thing called the Stock Connect, right?
Okay.
And actually, you can invest in renminbi. Now, the renminbi is as a trading range with the US dollar too. Okay. I think it's actually quite interesting that you're investing in Chinese companies in Hong Kong using Hong Kong dollars, which is essentially pegged to US dollar. You're actually exhibiting less currency risk. Right? It's actually, however, It's just a matter of whether your broker allows you to do the currency conversion. So if you invest in Chinese company in the US on the US exchange, you're investing in US. You use your US dollars.
Yeah.
So it a lot of the institutional investors, if you look at how they actually operate, they actually, when they invest in global equities, they actually also manage the currency risk as
Yes.
well. Right. So
Yes.
and then you have some funds that actually manage the currency risk through hedging and so on. Or some funds actually do not actually hedge. So, if you invest in funds, they will tell you it's hedge or not hedge to your domestic currency. And these are some of the things that you have to think about when you're investing. Right. So whether
Sure.
you hedge your own currency risk or not. But I think
Sure.
it's actually interesting that the Hong Kong market is quite unique because you're investing in Chinese companies, but you essentially your currency risk is lower than if you
Exactly.
invested in, say, in Indonesia or in India.
Right. On that topic, so I think so. We have a piece coming out. I was trying to record it before this meeting, but looking at people's questions have been around, what happens if the US dollar collapses? And it's a really interesting question because there's really a couple parts to that. And I think they're all looking at the hyperinflation scenario, which is highly unlikely. It's sort of a black swan event. But what you might argue then for a retail investor who, look, the US dollar is quite strong. It's been consistently strong at sort of all-time high strength. Okay. So if you were to get some currency exposure that wasn't the US dollar, China, I suppose, would be a reasonable enough currency. I mean, it depends on how you want to look at that. But having exposure in another currency wouldn't even be seen so much as a risk, but as a sort of a hedge against the dollar falling. Is that an appropriate way to look at it? If you're a U.S. investor with a lot of U.S. dollar exposure?
Well, that's actually quite intriguing question. You have to actually consider a lot of things, I think, because ultimately, you're right. The U.S. dollar has been strong, but as you know, what's happening in the U.S. right now, there's a trend where I think the current administration would like to see the dollar weakens,
Yes.
right? Now, yeah, certainly, if the dollar weakens, it alters your your exposure in terms of the foreign currency risk of your portfolio. If you invest in a portfolio that has foreign currencies and foreign companies. However, then you have to think about, well, how does the weakening of the dollar affect the actual company's business?
Yes.
Right.
It gets very complicated, right?
Yeah, it's quite complicated.
Really,
It might help. It might help certain companies in exports or not. So yeah, that's
what's there's actually I'm gonna just mention this because it's interesting. Two quick things. First of all, it's something I was unaware of called the U.S. dollar smile. So when the U.S. economy is doing horrible, let's say it could be the global economy is doing horrible, there's a flight to safety for US dollar. So it props that up. So then on the other hand, when the US economy is doing super well, there's also a strong currency. So you have that smile effect, which is not intuitive at all.
Mm-hmm.
And MSCI did a piece, is actually Verbrack, and I don't know if you ever worked with him. He's a great guy. He's working on scenario analysis now. And what they did is they did a scenario for rising inflation, stagnant growth, and strong US dollar. And then they ran that scenario and it showed something like all across the board, every single asset class was hit. There was no safe place to be. And I think the conclusion was a 16% decline or something. The point being that I think, like you said, it's so complicated that this really rudimentary way, and I've asked that same question myself in the past and have been met with responses like, man, it's no simple answer. And indeed, when you start digging into it, there isn't. It's far more complicated. And there's so many moving parts that it becomes almost a silly thing to be worried about, right? Because it's just not very intuitive at all. So
yeah. As I said, generally, if you think about it, a weaker dollar generally makes emerging market goods more competitive. Then that increases export.
Exports, but the
However,
problem is if your exports are reliant on materials that you're importing, so that becomes tricky, right?
yeah,
So
yeah,
and also the U.S. runs that deficit, right? So that's the idea. So yeah, of course, I've always thought like, look, let the U.S. dollar get as cheap as possible. It's great for us because people come and buy goods and services, but at the same time, we're having to import more, and that gap, that trade deficit, is growing over time, and the administration's trying to fix that, right? The other interesting thing I thought is this comment from Trump, and again, you don't know what's bravado or what he means seriously, but he said he wanted to reduce rates. What if, so look, the tariffs are going to cause increase in inflation, right? And he says you want to decrease interest rates. That's the opposite way. What that actually do is supposed to, I don't know if that's true, it's supposed to compound inflation. So he's actually taking a wrong approach there. What are your thoughts on that? Is that correct? Like,
I think that the general consensus is, if you're trying to decrease, he's trying to decrease rate in order to help with the deficit. The debt burden, right? So because you've got, if I remember correctly, I think the U.S. Burden, the debt burden on the interest payment is more than next year will be more than the defense budget, right?
Yeah.
So he's trying to decrease, trying to make sure the U.S. Interest rate goes down, so that then there's the payment to the interest payments will be lower. However, with the tariff, that's going to increase the inflation. The Fed is sort of hands are tied, so your inflation is going up. They might have to increase rates, right?
Right.
That's what the worry is at the moment, right?
It's really complicated. I was surprised how, and the piece is good. We're going to put it out. It's good, but it's just so complicated. When you start getting into the economics, man, it's like it just becomes very inactionable. Mm-hmm. And as we continue to say, you have to have a strategy before turmoil that you have enough conviction in that you continue that through turmoil. You can't start selling assets and moving assets around in response to this massive volatility, which is volatility in itself. Every morning you wake up, there's something different. Massive volatility within volatility. Let the dust settle. Let's get through to summer or maybe to fall. And then let's evaluate, what's going on in the market, because it's just too much stuff going on.
Too much volatility. Now. Yeah, the volatility in the last few weeks is just incredible. You can see, look, how the VIX has gone up.
Yeah. I know that we were talking. You trade on the VIX. So I wanted to just finish the VI conversation out. So you had mentioned this Stock Connect. Can you say what that was again? This Stock Connect. What was that called?
So the Stock Connect is something that I think came into effect many years ago. Actually, maybe in the last 10 years. That this allows you to there's a southbound and a northbound. So a northbound means investors in Hong Kong can directly invest in Chinese companies listed in the Shanghai and Shenzhen Stock Exchange.
Okay.
And it's all ring fenced. So this provides direct access to the A-share market. So the A-share market is the onshore market in domestic China.
My understanding is that Joe retail investor doesn't have access to that. Let's say
the Hong Kong investor, you can use the Stock Connect to invest in onshore China. That's what it was designed for.
But you have to be in Hong Kong, or
I believe so, because
you have to have a Hong Kong account, and when you go to open a Hong Kong account, then you've got to. I mean, that's the trick. I keep an account open here for that reason, because it's a very difficult thing to do, right?
Yes,
so
yes.
It once you've done that and you jump through all those hoops, then you can go. And I think that even then, I'm not sure about the permanent resident thing, but at any rate, for most retail investors, that isn't going to be an option. So I think looking at that as some viable way to invest. So really, it comes down to accepting the VI structure risk. And, I think earlier you're talking about A shares and H shares and things like that, BYD. So maybe that's a good segue to talking about BYD. So here's a company that, because it's an automotive firm, it's not subject to these restrictions by the Chinese government. And it's one of the 10 largest companies in China now. It has a very interesting, there's a number of interesting dynamics to that firm. And I wanted to sort of talk to you a little bit about it, because certainly you see here on the streets in Hong Kong, you see those, what are the seals all over, right? They're beautiful cars. And BYD is just everywhere you go in the world now, aside from North America, you see BYD's showrooms. They're pushing so hard. So, Cedric, a couple questions there, and they're really okay. So 90% plus of BYD's vehicles are sold domestically, right? And they seem to be doing a good job there. And now they're starting their push to export. And so you have that electric vehicle thesis in itself, right? The fact that BYD's been able to make vehicles now with the total cost of ownership lower than a petrol-powered vehicle. And that's what we needed, right? We need, if electric vehicles are going to be deployed at scale, they have to be cheaper to operate than gas-powered. Then you have a real advantage, okay? BYD recently announced this fast fill battery, and my understanding is that they're going to deploy somewhere around 4,000 chargers in the mainland, and that what this will allow you to do is to fuel an electric vehicle so it's twice as fast as Tesla's fastest charger, and it allows you to fuel something in like 5 minutes. So now you're able to fuel an electric vehicle as fast as you can fuel a petrol-powered vehicle. And they've deployed this God's eye autonomous technology, where we literally went from 2 years ago questioning, it's a bad thing, BYD's not doing anything autonomy, and all of a sudden they've just accelerated like crazy. The question is this: how much of this banter that you see around BYD and their 100,000 R&D engineers and all this, how much do you think that's just talk and marketing versus they're actually able to do those sorts of things?
Well, I think you cannot underestimate, the technology advances in China. Definitely not, because they are able to, look at technology and dissect technology and create something that's equally as good as any Western designs, and then they can produce it at a much lower cost. BYD, I think, right now is the largest manufacturer of electric vehicles in the world, and they export globally. I've been to so in Hong Kong, for example, the number of BYD vehicles is just grown tremendously. I go to Australia, and they are selling it there. They're exporting it in Europe as well. You see them around. And interestingly enough, if you look at I did look at the chart of BYD versus Tesla in the last month, and you can see the dichotomy immediately. One is going up, and one is going down. There are many electric vehicle manufacturers in China, but BYD obviously has been the leader, and is investing in both in its manufacturing process and the battery technology as well, right? That's one of the most important things.
30 to 40% of the vehicle cost is the battery. What's interesting is that when you looked at, even when Buffett moved out of his position, I don't know that it was ever that meaningful to begin with. I don't think you take it with a grain of salt what Buffett was doing with BYD, but I can recall at a time when it was something like 40% phones and like 60% auto. Now it's moved to 20%. Let's call it other. I don't want to say phones because that might be misleading. But my understanding was that their competitive advantage and where they were dominating and able to get their batteries in so many phones was their battery technology. And then so I heard they're like the second largest producer of batteries, EV batteries, next to CATL, or whatever, I think, whatever that firm is, right? So they're saying that, and that's why that battery question is so important. And your response is, well, don't underestimate. I completely agree. I think that they said the reasonings. I think they said something about managing temperatures and a number of things. And of course, you have the critics saying, oh, that's bullshit, and all this stuff, of course, right? But once they deploy those chargers, and I think they're making that fast charging feature available now in several models, that's pretty remarkable. And the fact that this autonomous functionality, which comes in 3 different flavors, right, from advanced to intermediate to basic, when I think one doesn't have LiDAR, but it's actually quite comprehensive. And they're going to start deploying that and just making that available in all their vehicles. That's kind of a crazy strategy, right? Where other firms are trying to make that a value add. So I wonder with BYD, you know how they invited Elon over and he built his factory and you got the Shanghai super factory. How much of that was, how much of that, and you don't want to sort of think of them as sitting and observing and spying and stuff, but how much of that was really inviting a superior technology firm over so they could observe how they produced vehicles and manufactured. They would be able to do that much better with the factory in their own country, right?
Yeah, but I think BYD has been producing electric vehicle for a long time before the Gigafactory was built in China. So
they could certainly take best practices, right?
Yeah. But I think the 2 points I want to bring up, right? One is, excuse me, when you talk about electric vehicle producer, right? You look at what Tesla is doing, right? How many models they have. But if you actually look at BYD, they're not just producing vehicle for people to drive. They also manufacture like taxis, buses, and so on. So you got to you have to look at that as well, right? So you don't see it in maybe in the US, but for example in China, in Hong Kong, you see taxis that are BYD, and they also have buses that are BYD, right?
That's where they originally started, was their buses.
Yeah, people just think, oh, okay, well, I don't see they're selling vehicles for people to drive in, but you have to look at their commercial vehicle business as well.
Right. So yeah. No, I completely agree. It's a much bigger. What's tough, Cedric, is like trying to get, they don't even have a damn investor deck. Like there's nothing there, right? With the Chinese firms, there's just no incentive for them to produce any sort of collateral that you can peruse that describes, and maybe even before they were doing a better job of that, I can recall back in the day. And now I went to look and try to find an investor deck where I can sort of paint this picture that you're describing. It's tough to do. You almost have to put something together yourself, right? And we may look to do that and to try to better describe the firm that way. But in a recent piece that we did, we sort of set aside the fact that they're dominating in electric vehicles and reducing. I think their next version of Blade battery is going to reduce cost by 15 to 20%. It's just remarkable, right? The things that they say they're going to do. And I think to what you said, they're probably going to accomplish these things, what one would think. Yeah. So they're trying to mimic Tesla in that they have that autonomy piece, okay? And crazy, the number of miles that they say they're, again, I don't know. There could also be some lost in translation stuff there, right? So you hesitate to take some of these numbers at face value. But the fact is that now they're starting to accumulate training data. They're getting into autonomy. Okay, when you look at the Tesla bull thesis from ARK, somewhere around, more than half of the present value of that firm is in the future of autonomy and to a lesser extent, the humanoid component, right? And of course, the energy. So we can see where they're going with the autonomy. The humanoid thing, I'm curious what you think, first of all, about, BYD saying, well, so they say they're going to produce a humanoid robot. I think they're going to demo it in July and they're going to be selling them by November, right? So that seems to be the cool thing to do. So I'm curious what you think about humanoids, the advancement of humanoids in China from what you're seeing, and what are the sort of use cases they can be used for. So, for example, in all hotels in mainland, you now have robots delivering things to room. That's standard. That's in all hotels. That form factor is not going to change. That wheeled robot's always going to be there. Humanoids aren't going to displace that. What are humanoids? What's the first use cases you think you're going to start seeing in China?
Well, I think in some certain industry, as well as maybe in factories and so on.
Factories,
okay. Yeah. there's still quite a lot of hype around that. But when you think about humanoid, I think that's just the tip of the iceberg. But when you look at real automation, there's all these robotics that are in factories where they're factories where there are no humans.
Mm.
They're actually factories in China where it's all robotics. But when you think about humanoid robotics, people just think about robotics as sort of robots that move around. But
Yeah.
you have to look beyond that, right? Because that's just sometimes it might be a bit gimmicky, just like you see what
Right.
Tesla is doing. Yeah, eventually you might have like a humanoid robot at home. You know, but the question is, versus the industrial use of robots. That's probably small, right?
Because the form factor for robotics in manufacturing and industry doesn't have to be a humanoid, right?
Exactly. Yeah.
It
Exactly.
doesn't have. So I'm just trying to understand, like, where you would need a humanoid like that, where you would need. I mean, it looks cool, like you said, and everything. And I know that the first implementations, they say, because there's companies in the US, I think it's Figure, and they're working with BMW, and now they're deploying humanoids in these in auto manufacturing. It seems a bit gimmicky because, like you say, these lights out factories, they don't even have humans in there, and they run them with no lights, right? Lights out factories. There's a lot of those. You don't need a humanoid walking
Yeah.
around in there.
Exactly.
It's stupid,
Yeah.
right? So I'm
Yeah.
trying to think, what's the use case? Okay, so you can argue, come on, man. In Hong Kong, we know that the substitute, if that humanoid becomes cheaper than a Filipino or a Filipina or an Indonesian person, we know that that's probably going to be something that you're going to see more of. There's a cultural use case, right? So maybe people don't know, and everybody in Hong Kong has maids, right? That's pretty, I mean, it's not everybody, but it's a pretty common in this society. That's a very unique thing. Middle East as well. Okay.
Yeah.
Going to that housekeeping function in this society, that might make more sense than perhaps in US society, right? Or in other societies. So I haven't been able to, aside from the gimmicky thing, and if you ever deployed a humanoid in any sort of service function, it would be overwhelmed by Chinese people taking pictures with it, and the thing would never get any work done. I'm telling you, right? That'd never work out. I'm just trying to think where they're going to see usefulness for that, and looking at what BYD said. Well, they've been testing with, is it Ubitek? Who's the humanoid? One of the six little dragons. There's a humanoid manufacturer there that they've been testing. So I think they're making a build versus buy decision.
Yeah.
And then I was reading that it's tough to get information out of China, but I was reading that supposedly they're going to debut one. So overall, with BYD, it seems like if you just took the electric vehicle thesis alone and their energy, and ARC proposes this energy storage component of the thesis, which makes sense, right? If they're making superior batteries, they should be able to do that. Energy storage aligns with green energy, right? We need that sort of thing. Are there any downsides, you think, or red flags for investors that may want to invest in so we have Wyatt looked into this, the Deutsche Bank sponsoring that ADR, is that right? The BYD ADR.
BYD,
and so we have an ADR, it's BYDDY, is that right, in the States? So we've got that ADR, and that allows us to invest without having to have a $25,000 minimum. So is there any concerns you'd have with an investment in BYD? Cedric, that would...
Well, I don't want. Well, I'm not a registered investment advisor, but I think go back to the ADR. The ADR is a special structure where it's supported by shares on the primary exchange, so it's slightly different from a secondary listing or something like, or a primary listing in the US. So, so you buy an ADR, it's supported by the primary listing, so it should just trade according to the I think this one is linked to. Is it linked to the Hong Kong stock?
Yeah.
I think that because the Hong Kong BYD stock, it's worth what 1.
I'm not a concern. Yeah, I wouldn't be concerned about that structure at all. I think that's pretty straightforward. You have an 8 share listed in Hong Kong, which is totally legitimate. You have Deutsche with ADR in the States, and which allows you to buy smaller amounts, right? I think that's all pretty straightforward. But just as a company, or as that thesis, the electric vehicle thesis. So one argument might be that state-owned auto manufacturers dominate in China, and that they've sort of let BYD go out there and play around and have more access to things because it's not state-owned, and that really that these state-owned vehicle manufacturers could potentially, put a crimp on BYD, right? That's one argument, or that their export plans may not go as planned. Okay, here's one for you. This is a popular one I get sent all the time. It's this guy who did a video of these vehicles in this field. There's, I don't know. I did a rough count, and it's not very many. So he says, well, China manufactures all these electric vehicles, and they simply put them out in the field, and they're lying about their numbers. So first of all, somebody has to buy these things, right? If you count the number in his video, it's not very many, so it's not proof at all. I didn't find that to be compelling at all. Have you heard of this video? People always forwarding it to me.
Okay, I haven't seen it, but again, if you look, I think you have to, when you look at China, there are certain themes that you have to look at as well. Sort of the Chinese, what are the main Chinese policies, right? That would help certain industries, technology, internet, electric vehicles. The electric vehicles been talked about for a long time, and this is one of the main industry that China is looking at for the last 15-20 years, essentially, right? Green energy, and also, there's all these things that happen in China that people think, oh well, it's not, it's China, it can't be happening. But actually, there's a lot of you can say good things that's happening in China, in terms of technological advance and reduction of environmental protection and so on. There are these, because it's people, we think China is sort of the emerging market and they do things differently, but actually there's a lot of things that's happening that's linked to the policy of the government. The electric vehicle is one of them, and clearly
is one of them, right?
Is one of them, and BYD has been riding that benefit, and also it's is an advanced company, and it's Buffett bought into it. Yeah, and it's exporting globally. And okay, you can look at what some of the discussions around dumping of and government support of certain companies versus what WTO would say about the government supporting certain industries to undercut certain other countries and so on. But then you still have to look at a company as a whole. What it's doing.
Yeah, I agree. I think so there was somebody at Ford, and I like getting this stuff from people. They forward all these bits and pieces. One of them was this lady. I don't know if she's Chinese based, but she had a number of points of contention. One was around their technology advancements, which I didn't find compelling for the reasons that we already talked about. But one thing that was mentioned, and this was a short firm, you may be familiar with them, I can't recall the name, GTM Research or something, I think they're Hong Kong based, that talked about the credit that BYD has been extending their suppliers, I believe. So, not the credit they're extending, the credit they're demanding their suppliers extend to them. So essentially, if you calculated that as debt, they would have a massive amount of debt. So it's money that they owe their suppliers that they get extremely lengthy terms on, like up to 270 days or something.
You've got bargaining power as the largest manufacturer.
That's the answer. That's the answer, right? And people were like, agreed. So you see other firms doing that same damn thing, right? They're saying, listen, we're the biggest person around, so you're going to have to play by our terms, and they're going to favor us. So that was the response to that. And I suppose that if there was any sort of a crunch or anything like that, then that could potentially lead to problems. But your response, I think, is sort of what it seems to. I mean, they should be expected to try to leverage as much as they can and pay as little as possible, right? I mean, that's free loans essentially, and yeah, that could potentially get them into trouble. But it's just what you ought to be doing. I think other EV manufacturers do that, but not to that extent that BYD does. Right.
Yeah.
Do we want to do some like Q&A too? We've had a
sure.
couple questions here and there.
Yeah.
I think the first one was related to Nvidia and sort of the chip restrictions to China. He or she was saying, what are our thoughts on Jensen meeting with the DeepSeek CEO? I guess he just flew over yesterday.
Right. Yeah.
Is it a sign of major companies willing to cooperate with China and sending a global signal of wanting to chill tensions? Do you have any?
Right. So we did an entire video on that. It's coming out in what's today? Friday. So it's coming out in 24 hours, Wyatt, or is that more or less?
About 24 hours. Yeah.
It's already done. We were going to release it earlier, but we wanted to stick to our normal cadence of releasing videos on Saturday. So we evaluated this in 15 minutes, and it's quite good. Okay. Your question is about Jensen flying over. Of course, that wasn't known when we did that video. I don't know what that means, and maybe we could try to speculate and think. It shows.
As far as I understand, he met with the vice premier in China, but I think he goes to China regularly. I think they have, I don't know how many, they have a large number of employees in China actually, if I remember correctly. So I don't know whether he met with the DP CEO. I mean,
I think that was quite as maybe yesterday. Yeah, I was just reading about it. It looks like with the H20, being restricted, I think they're trying to come up with a new chip that they can develop custom for China.
That's going to be. I mean, what do you build something even? So there's a theory that's probably pretty true that says that $5.5 billion write-off is because they couldn't do anything with these chips, that they had throttled down so much that nobody wants them, right? Mm-hmm. So I think that and it's interesting because what had happened after that DeepSeek news is that Alibaba and Tencent and others had lined up $16 billion of purchase orders for those H20s in the first 3 months of this year. That would double China's H20 chip count. So what they did is they all came pouring in saying, we want as many of those things to make. Then they put the clamp down. Remember, they didn't ban them. They simply said that you need a license. But I think
exactly. So I think you really have to look at the news and digest the news, because there's a lot of stories going around. So I think my understanding the I can't remember, is it the H200 chip?
H20.
Yeah, I know the H200.
Oh, 200. H200, right?
And then the H100. The H200 is not that much lower than the H100. So even though that was the one that was supposed to be sold in China, and then they've got the H20. Look, I think there's a lot of demand. That's my personal view of the chips. If you look at the chips that are developed by Huawei. Actually, it's interesting. There's a website that I've been to that actually you can see if you want to rent out a chip to do some calculations for you. There's actually a website in China where you can basically rent chips, right, processes, and you can see, and actually it tells you how much you want to use a H200 chip, how much it will cost. So you should run, I don't know how many cycles of calculations, and then you can see all the other chips that are produced by the local companies like Huawei and others. So it is actually a very, very interesting. The Huawei chips are very cheap compared to the and you can see the performance differences as well. It basically lists out performances as well as costs to run it.
Yeah. That so there's a bit in that video. I think to answer this versus question, I think in our video does a pretty good job of covering a lot of this, and you ought to give that a watch. And I can't believe we've already burnt almost an hour because we haven't even got through half of what I want to talk. Maybe we have to have another conversation, Cedric, because these are always super informative and fun to have. The time goes by so quick. So I would just say that question on Nvidia, let's put that on hold for this video on Saturday. What other questions we got, Wyatt?
There was some banter about, some use cases for humanoids. One person mentioned soldiers and one person mentions healthcare. So with healthcare, saying, they know some people in nursing industries and it's kind of backbreaking work. So maybe there's niche cases that, I hadn't thought about, but I thought that was kind of interesting. And the soldiers thing, someone says it sounds like Terminator. So
wouldn't it be interesting if if we got to the point where we just had all the the humanoids went out there and everybody we could televise it, and it's sort of like everybody got down and the humanoids just battle it out, and that would be all that the winner would be. Was there any other questions?
Let's see. I mean, people were asking about the risks of delisting for ADRs. I know we talked about that. I see
this person that just says, we talked about the risks. Yeah. It's our understanding investors made whole 5 months after delisting. I don't have my money back. If that individual is on there, just say which one it is.
Yeah. Long Slack, if you have a name, a ticker or something.
Right. This could be, there could be more to that story. I think there's a big difference between a giant Chinese firm versus a small firm that was going to, we'd need more color into that. And I think somebody else had mentioned something about the 5 months after delisting, I don't have my money back, a lot of uncertainty. They had mentioned some asset. Yeah, there's going to be niche cases, but here's how it works. When you have Hyundai from, yes, this gentleman was either this gentleman, somebody else. We talked about this on Discord. Yeah. So have to look at the details on that. I think, first of all, you'd have to see just how many people weren't made whole, because I think that's the first thing, like broker, and which brokerage firm was it, right? If this is a mainstream brokerage firm or not, that would be interesting to look at, right? But it isn't typical. So you would typically, and I'm wondering if you didn't have advance notice. I don't think you did. I think I remember reading this. I found it odd. I think this is more an exception than a rule, right? But that could be an interesting scenario to look at and to try to understand what happened there, right? Because we can learn something from that. So generally speaking, I think that, with these ADRs in the States, when they're heavily traded, right, they're not just going to leave a whole bunch of people hanging, right? So it's a question also, how many people were left hanging? There's a lot of questions around that, but there's risks there, of course, right? Okay, what do we have?
Yeah, because actually, ADR is not just limited to Chinese companies. There are ADR listed in the US of German companies and other companies.
Yeah, even on the Nasdaq. I mean, I think like ASML is technically an ADR.
Yeah, that's what TSMC is an ADR of the Taiwan listing. So
yes,
yeah, that's right. It's a good point. I see somebody mentioning China buying huge gold, replacing the dollar. I think we talk about that in this US dollar piece coming up, which I think is quite edifying. And if I can get it recorded, it'll be pretty good. What other questions do we have, Wyatt?
I think that's, someone says, is the CCP's QE working from your perspective? Is that quantitative easing? Is that QE?
I don't have any opinion about that, Cedric.
Yeah.
Well, that's been actually since last September, there is there's a lot of easing that's been done. Clearly the Chinese economy is not at its top, and that's well known. So there's been stimulus plans that was announced. A number of plans were announced in September, and that driven a rally in Chinese stocks in during that time, and in recently as well. There's given, I think that the Chinese government mentioned that they wanted growth to be around 5% this year. 5% growth GDP is actually very, very good. Let's try to maintain that kind of level. Everyone knows that the domestic market is a bit tricky at the moment with the real estate market that blew up before, and with current trade tensions, there's a lot of issues that needs to be addressed, and clearly the Chinese government doesn't want to see the economy tank, and nor the stock market. So there's been a lot of announcements of easing and stimulus, and every time there's a mention of that, the market rally a little bit.
Mhm.
But then you have to look at, because the announcement is the announcement, and actually when they're actually going to do it is the important thing. They can announce whatever, but then if they don't implement it, and then the market tanks.
So maybe I'll finish it off with just one question here that I had. So we did a piece recently, Cedric. It looked at MSCI's weighting of China. Okay, so I think if you do ACWI, it's what, 3%, something like that. The GDP weighting is much different, somewhere around 20%. The question to you is, I'm curious, given your background and your knowledge of China and your geographic location, things like that, is your exposure to China greater than 3%? Or are you trying to stick to sort of the exposure that there's two exposures you can have? You can either take a GDP approach, which I think the answer is somewhere in between, but I'm curious what you think.
It's interesting that the GBD weighting has been talked about for a long time, and you see some investors that have try to invest in towards that kind of weighting, but globally, a lot of investors, I'm talking about institutional investors, fund managers, and so on, typically stick to the standard market cap weighted weighting. I think you have to look at sort of the growth and what's happening within the market. The Chinese stock market doesn't quite reflect the economic growth of the country. There's a lot of restrictions in investing in the Chinese market, and you've got also geopolitical risks and so on, and that's why you see the valuation of Chinese stocks are much lower. If you look at MSCI China or MSCI Hong Kong, the PE is much lower than the US. US
half,
is
somewhere
20% now coming down, but Hong Kong has been low at 14, and China is around slightly higher than that. So it all reflects the sort of uncertainty in investing in that market, and also risk associated in investing in the country, whether you're able to repatriate money, or whether there is sufficient investor protection and so on, right? And changes of regulations within the market. So all this goes into the actual valuation of companies within the market.
Yeah, and I had commented, I think, when we had met, that even so, you look at the historical performance of China, it's just dreadful, right? Doesn't do anything.
Yes. Yeah.
And then you go to China and you look at what has advanced in the past 20 years. It's mind blowing, and you see the gap widen, and you think to yourself, wow, there's value to be had, but not necessarily, as you just said, right? There's no free lunch. That's a real temptation, I think, if you start to pay attention to China and see what's going on there, to think that, and you'd like to think that you have this saber rattling right now with the current administration in China. And what if that worked out in a positive way, right? And it's certainly, well, cool. We don't know. We need the dust to settle from that. And, then you might see, some opportunity. But just going to this person's question, and I know that we're now 3 minutes over, and we can go a couple minutes over, I think, before I get kicked out of here. But so it says, this person had asked about China's budget deficit and debt, and I wanted to comment on debt. I don't know about budget deficit. I'm not sure if you know about that, Cedric, but I want to comment on debt. If you look at just on the tin, and in our China piece, there's an article that we linked to. It was by Fidelity, and it's not actually Fidelity. It's some Chinese firm called Fidelity that manages nearly $1 trillion in AUM and whatever, right? And this lady had done this piece on this, and she did a great job of talking about how if you bring in all the sort of debt on the shadow banking side, the total amount of debt that isn't just what you have on the tin, that they actually have a bigger pool of debt than the States does. So their debt problem potentially could be as bad or worse than the United States. Of course, there's people that argue the United States doesn't have a debt problem, but I think if you look at where we're heading, it's hard to argue very hard to argue that, right? But is that your perception then, Cedric, in terms of debt and their deficit?
Well, I'm not an economist. I don't have a comment on that. I apologize. I have to do more research. But I do want to go back to about the valuation. I mean, look at you look at the valuation of Alibaba versus Amazon, for example.
There you go.
Just it's a massive difference, right?
Yeah, crazy difference.
If Alibaba is valued at the same, I mean, essentially it's doing similar business, then the stock price of Alibaba wouldn't be at this level. Similarly with Tencent.
Exactly. Not even close. So what's interesting about that, Cedric, we've got all our stuff is documented, right? And there's a piece we did on Baba. It's called, I think, The Bear Case on Baba, a long time ago, because we used to hold a large position in Baba and then exit it at the right time, right? Of course, that had nothing to do with luck. That was all our superior investing acumen, right? So the point was that, first of all, there was the VI structure thing that was concerning, right? And I think we've learned a lot about VI structure since then. But this gentleman, and I can't recall who it was or what has ever come of them, was doing some analysis, just some cursory analysis of financial numbers coming from Baba and pointing at things and saying, look at how absolutely ludicrous this is. Now, he was digging quite in and making certain assumptions and had this whole set of information. And the takeaway from that was simply this: if I was going to invest in Baba again, I'd want to vet all those accusations. This is a long time ago too, so should they either hold true or not. The point was that Baba almost seems a bit too good to be true, right? So I think that you'd want to sort of, because I don't think you can just explain away that valuation gap between Baba and Amazon with China. There's
also the key personal risk as well. Actually, Alibaba has recovered a lot in the last 6 months, just because Jack Ma started appearing. I think he was in Japan, now he's back in China, and then he appeared in some of the state TV, and he met with the premier, and there was a gathering of tech leaders, and he was there, and that fueled a lot of the speculation that he's not in the dog seat anymore.
Yeah, Bob, that man, I wish that everybody knew, and I don't know, told the story many times, right? All the different remarkable, how persistent he was. What an amazing success story, right? The amount of failures that he took, and I don't know if half of them are urban myths, but if half aren't, it's just, he's a remarkable person, simply remarkable person, right? And a good reason, I think, that bull thesis was so compelling was just how damn good he was. So yeah, when he did disappear, that was certainly a problem. Well, look, we're already 8 minutes over, so I think we would probably wrap this up. But thanks, Cedric, for joining us. This has been
You're welcome.
Really informative, and we can certainly later on look to have more conversations. I think we got to a lot of the to-dos that I have, but certainly there's a lot more that we can come up with, and especially so I told you there's a ton of interest from our premium subscribers on having more China research, right? So
yeah. I think we can talk a little more about ETF, because I saw one of your subscriber mentioned MCHI and others. There's a lot of different ETFs that are exposure to China, but very often in the mainstream media on Bloomberg, they will say things that's not quite correct. They keep talking about certain type of indices which has very limited Chinese exposure, or they're just US listed and doesn't get broad Chinese exposure. So I think we can talk about that next time.
Great. So I'm going to make a note of that, because that's a perfect conversation topic, because I really would like to pick up where we left off in our rudimentary analysis of ETFs, where we sort of gravitated towards the one with the low expense ratio. And I had questions. I couldn't figure out why they had such a low expense ratio. Let's then pick that up in a future conversation and look at that. And as I mentioned to you, you know, this VI structure thing is so important because we may look to hire a Chinese resource to produce Chinese content in the fall, or certainly after all this geopolitical dust has settled. Maybe it doesn't settle, things get worse, and it isn't a good idea at all, right? So we're leaving that open, but that would be quite interesting, right? Though there's a lot of risks associated with that. But I think, as you said, that the next thing to discuss that would be really good is to really talk about, especially with your background in indices, that would be awesome. So we'll set that up. I'm heading back to the States pretty soon, but I think we can set this same sort of time frame, right? If that works for you. Again, Cedric, thanks so much for your time. It's always a total pleasure chatting with you. We learn tons, and the time goes by so fast. That's how I know it. It's just a great conversation. So we'll go ahead and leave this. Thanks so much again, Cedric. We'll talk to you soon, man. And we'll set up another conversation in the coming weeks or months or whatnot.
Okay. Great.
Thanks,
Thank you. Have a good night.
All right. You too. Bye-bye.